All right, welcome. We are back with another Finance Friday course. It's good to see everybody again. I was out last week, so if you tuned in last week, you got to see Rodrigo and Nano teaching. I'm back this week, so you guys are stuck with me once again. I was in Puerto Rico for a couple of days, and that's where I was, but I'm back, and we are going to be talking tonight about how to set up a sacred account using life insurance, okay? Now, this is one of my favorite topics, and before we dive into it, I want to cover some ground rules, things that I always cover. So number one, if you haven't already, figure out your purpose for being here. If you have a sacred account already, what is the reason for attending? Are you trying to learn more about it? If you don't have one, what made you interested? Why are you watching? What do you want to get from this, right? The second thing I want you to do is remove the idea that you can't learn about this, that money is too hard, that it's complicated, that it's for everybody else, because none of that's true, right? Money is just math. I talk about this all the time. So if we can keep it simple and realize that it's all just vocabulary that represents basic math, right? Just basic arithmetic is really what it comes down to. Then there's not any issue understanding the financial side of it, okay? So that's the first thing I want to have you understand there. The second thing is to get rid of the idea that we know it all already, okay? Especially if you're a client, you've learned about the sacred account before, you probably have taken courses on it, you know more than most of the population, right? But there's always still more to learn, okay? And so the idea that I know it all really is an excuse not to learn. We want to get rid of that and make sure that we have knowledge as a constant, not as a static position of, okay, I don't need to know anything else because I learned this once, right? So I want to make sure that we have that. Secondly, in addition to that, we will answer questions. So drop your questions in the chat. If you're on Facebook, we'll read them off. If you're on Zoom, we'll mic up and we'll talk as we go through. And then I also want to make sure that everyone has a focus on production tonight, right? This is important. If I'm watching this course and I don't have the intention to use the information, I'm not going to learn it, right? So if I'm not using the information and I'm not going to learn it, it kind of goes back to, okay, well, why am I here? And it goes back to that purpose. So tie your purpose to action as you're learning something. And this is how I learn. When I'm learning from somebody on a topic, if they're an expert, I'm asking, okay, like, how does that work? Why is he saying that instead of this? And I'm getting into the nitty gritty of what's being discussed that I can really understand and apply the topic. Okay. So all of those things are important, right? So make sure that you have all that before we get started. We're going to be talking about life insurance. Okay. Now this might be your first time ever hearing about this, and you might have a confusion on what life insurance is and what it's for. You might have heard this before and you're privy to what I'm about to share with you. But this is life insurance being used as what we would call the sacred account. Okay. Now, what is the sacred account? It's a marketing term. It's something we use. It's slang, right? But it's high early cash value, dividend paying whole life insurance. Now you can see why we call it the sacred account, because that's a lot of words to tell someone with, like, what is that? It's like high early cash value, dividend paying whole life insurance, right? So we just call it the sacred account. That's what that represents. The sacred account is a concept. Right? The concept of the sacred account is to have a real store of value that collectively we save 40% of our income into, right? And then we're going to have that store of value growing and then borrow against it through the collateralization of an asset. Collateral means when I get a car loan, the loan with the bank, the car serves as collateral. It's the thing underlying that gives the loan security or value, right? When I get a mortgage, the house is the thing that serves as collateral on the mortgage. So when I'm borrowing against an asset, the asset that I'm borrowing against serves as collateral on the loan, in this case, life insurance, right? So these are important things to know. Now, the first time I ever learned this concept, I was the biggest skeptic in the world of it. Okay, I was a Dave Ramsey financial advisor, and I thought I knew it all, right? I thought I knew it all. I'd done it all before. I have a story to share with you guys on the topic of knowing it all and then finding out you don't. So you guys will love this. I was in Puerto Rico over the weekend, right? And in Puerto Rico, they speak a lot of Spanish. I was with my friends. They're Argentinian. They also speak Spanish. When I was a little kid, I watched a movie called National Security. It's a comedy. It has Martin Lawrence in it. And there's a scene in that movie where he has to speak Spanish, or he's trying to. And the only phrase he knows is, hay un gato grande en mi pantalones. That's the only phrase he knows. And in the movie, in the captions, and also what they said in the movie, they're like, you just told everyone you have a large cat in your pants. So I thought that was funny. I was like 8. So since I was 8 years old, I've been repeating this over and over. Whenever someone speaks Spanish, that's the only thing I know how to say, right? And I was like, man, I already know what this means. It's funny. It's a safe phrase. So literally, I get out of the airplane, I get into the car with my buddy and his wife. I've never met his wife before. This is the first time I've met him in person. And they're speaking to me in Spanish. And so I'm just like, oh, I'm going to do my little thing. And I was like, hay un gato grande en mis pantalones. Their eyes got this big and they just stared at me like they couldn't believe what I said. Right. And I thought I knew what I said because, again, I knew it all. I was like, oh, I've heard this before. So it turns out the literal translation in Spanish is I have a large cat in my pants. Right. Nano might know this. It's also a slang. It's a sexual innuendo. And I didn't know that. So for the last, I don't know, 15, 16, 17 years of my life, I've been repeating this to people. And it's a sexual innuendo for a man being excited and having an excitement in his pants. And so I'm sitting in the car and I'm sharing, I'm like, I got the grande in my pantalones, and their faces just go red. And I had no idea, right? And that's what it's like. We've all had that experience where we think we know something, right? We think we know something. I always have a phrase, nobody is more certain than the idiot, right? Like the idiot before he knows he's an idiot doesn't know he's an idiot. So of course he's 100% sure. It's like, yeah, this is what you do. This is how it works. That's how I was with life insurance. Okay. That's how I was. And it was something where, I was so sure of it because I was a financial advisor and I had all of the licenses. I was endorsed by Dave Ramsey in like 8 states. And I knew my stuff and I was certain that I knew my stuff. And so when I was presented the idea of using life insurance as a store of value to fund my investments and fund my large purchases, immediately I wrote it up. I was like, no, I know everything. You only buy this type of life insurance. You never do the whole life. You never do the cash value, and you put it all in mutual funds in the stock market, right? And that was what I knew. Now, the problem was I was in a system where I was the consumer. I'm going to share with you what I mean. When you get into the financial world, there's different layers. I'm actually going to draw this out because I think this gives a really good visual. There's layers to this. Nano, did you know about the Gato Grande thing? I actually forgot to introduce Nano. So Nano's on my team. If you guys are in the comments here, Nano's going to be reaching out to you in the chat. Nano is one of my marketing and sales managers, and he'll be reaching out to connect with you. If you're brand new, his goal and his intention is to set up a call with you, answer your questions, help you implement what you're learning today. If you're a current client, he's just going to check in and say, hey, and see if you need anything. One of the things that he will offer is to get a copy of my book, Blueprint to Financial Freedom, right? So it's going to be maybe an hour-long webinar. We're not going to learn everything tonight. This is going to give you something to study after the fact. If you're watching the replay, you can go to jerryfetta.com/B2F because Nano can't DM you in the replay video comments, but you can get the book on your own. So again, Blueprint to Financial Freedom, and you can go to jerryfetta.com/B2F. So make sure you message Nano back if you get a comment from him. So basically, in the world of investing, we have what's in the middle. We have a deal, right? I just call this a deal. What is a deal? A deal means something that could make money. It's a house, right? And so I buy the house and I own or finance it out, or I rent it out, or it's a business. And so I, build the business up and that makes money, or it's, something that's going to produce profit, right? And so we have a deal. A deal happens when an opportunity coincides with a deal maker. A deal maker is somebody that's opportunity minded and knows how to put a deal together, right? So this is a deal. That's all we need, an opportunity, and we need a deal maker, right? And the deal maker, they're going to find capital, they're going to find other investors or whatever it is that deal requires, right? But this is the basics. And so this is what an investment is. It's not a product, it's a deal. It's an opportunity and a deal maker. And when you include all of those things, you end up having capital and investors, and it turns into an investment, right? So this is like the core, right? It's kind of like when you go to a fancy restaurant, you see what's on the plate and it's all doctored up and pretty looking, but it's meat, right? It's meat and it's got some, carbs and some veggies. And that's the basic of what it is. Somebody that understood how to cook, they took all the ingredients and they made it look better than it actually is at its basic level. It made, they make it aesthetic and it's got all these seasonings and flavors, right? So this is where people invest. This is where people have always invested. When you go and you read and you learn about, the John Rockefellers of the world, when you read about the JP Morgans of the world, right? All of these people, they put together deals, right? Andrew Carnegie starts US Steel, one of the largest steel corporations in the history of the company. JP Morgan decides he wants it. He's a deal maker. He sees an opportunity. He knows that Andrew Carnegie wants to sell. He walks into a meeting, hands him a slip of paper with his asking price, and he doesn't say a word. And then Andrew Carnegie shakes his hand and accepts the offer. Now we have a deal, right? So in order for this deal to happen, in this example, JP Morgan had to get financing. He had to go get money. He had to figure out, okay, how am I gonna pay for this deal? This is a multi-million dollar, probably multi-$100 million deal that I'm doing with Carnegie. I need to get financing together, right? So with the financing, I need to get someone else's money if I don't have my own, right? Which means that there's also then another layer on top. There's people, right? And so what I was looking at was this. Stocks are a way to finance deals. Bonds are a way to finance deals. Mutual funds are a way to finance deals. Annuities are a way to finance deals. I am not the one doing the deal. I'm usually on the outside looking in. I put my money into XYZ fund, right? And now there's an influx of money. And then the people that run the fund go and buy the assets. They're the deals, or they're the deal makers looking at the opportunity, using my money to do the deal, right? And so that's what this is. Now, the problem with this is the guys in the deal, they're at the center. There could be layers upon layers upon layers upon layers upon layers of these different levels of people and financing and people and financing and people and financing, right? So when you look at like 2008, what happened here, we had, a mortgage. Okay, what is a mortgage? A mortgage is a house, people, and some money. That's all a mortgage is. It's a house. I want the house. I need money. Where does the money come from? It comes from the bank, right? So this guy gets the money from the bank. He buys the house. This person over here, the seller, now gets the house. That's a simple transaction, right? But now we have this thing called a mortgage, right? And so in 2008, this was the deal. This was the financing for the deal with the bank. And now we have this thing called a mortgage. It's a payment stream that this guy makes to the bank. Well, the bank was then going out and they were selling this mortgage to another party, right? So they were reselling the mortgage. And then these guys were reselling the mortgage. And then these guys were reselling the mortgage. All the way back here, we had like mutual funds and pensions. And these guys were buying what they thought was a mutual fund. They didn't know that the mutual fund owned a resold mortgage from a resold mortgage from a resold mortgage from an original mortgage. You guys see what I mean? So this is not the deal. 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 This was the deal. You're like 4 or 5 or 6 degrees away from the deal at that point. Right? Like you're getting, the leftovers of the leftovers of the leftovers of the leftovers. So me with all my licenses, I would look at this mutual fund or this annuity or this pension. I'd be like, man, this is an investment. No, that is a retail financial product. That is not an investment. That's a product. It was created in a boardroom, right? A deal is not created in a boardroom. A deal is created with a deal maker and an opportunity, and they put the deal together. There's not a boardroom meeting. There's no marketing place. You just put the deal together. Anyone that's ever done a deal, that that's how it works, right? Nano says mortgage equals death pledge. So what does this have to do with life insurance? Okay, my confusion was, I know everything there is to know about investing. Really, I was a glorified financial consumer salesman. I had a bunch of licenses that said I had the permission of the federal government and the state government to sell retail financial products from Wall Street that were created in a boardroom. Right now, when I started learning about life insurance, I couldn't think with it because I was like, why would I need this? Right? Like, I'm just going to stick my money in the mutual fund. Why would I need this life insurance stuff? The mutual fund does everything I needed to do. It was a tool that I couldn't figure out where it fit in. So it wasn't until I realized the difference between retail financial consumerism, mainstream finance, right, and deal making. When I realized the difference between mainstream finance and deal making, that was when it made sense. Okay. I had this cognition in a conversation with a mentor of mine. I sat down. I was like, what do you do for investing? He was a real estate guy. And he's like, I buy mobile homes for really, really, really cheap. Okay. I fix them up and then I sell them on seller finance contracts for a lot more than I paid. And I get an income stream on a mortgage. Okay. And then sometimes I'll take that income stream from a mortgage and I'll sell it to someone else for more profit. And that's how I make money. Right. And that's for me when it clicked. I was like, that's deal making. I immediately knew, I was like, that's deal making. This guy's putting together opportunities and he's building this out in his own way. And he's not going to a financial advisor and saying, sell me a product. When I was a financial advisor, do you know what people used to do? They would come into my office and they'd say, Dave Ramsey said, buy 12% growth stock mutual funds. How do I sign up? And that was the extent of the conversation, right? Whether or not those mutual funds did 12% wasn't the thing they were concerned about. They were just buying a product. No different than you watching an ad on TV and saying, hey, I want that car. I want that piece of furniture. I want that boat. I want that. And you go and you ask for it and you buy it. You go to a restaurant. I want that dish and they bring it to you, right? Deal making is, okay, well, here's the pieces for a dish and you're not the one that's going to eat it. You're going to make it and sell it to someone else, right? So when I had that click, that was when I understood why I needed life insurance. Okay. So here's in a nutshell. I had this conversation with someone today. He's a guy that was a deal maker. He's like, hey, what does it look like to be the bank in a transaction? We were talking about this. And what I went over is, if you think about, for example, almost any real estate deal, there's a bank involved. Okay. Like mortgages, they're always being used even by investors. You look at business deals, there's a bank involved, right? You look at your car, there's a bank involved. You look at your student loan, there's a bank involved, right? So this is called the banking quadrant. This was something I came up with actually in the bathtub one day. I just thought of it and I was like, this is brilliant. So in a bank, you have 4 groups. You've got the depositor, right? You've got the borrower, right? Now, most people don't even know this much. When you put money in a bank, they don't just keep it, right? They loan it out. Your deposits are being loaned out. So when you put in money into a savings account or a CD or a checking account, the guy next to you getting the mortgage, this is a great way to think about it. He's borrowing your money, right? That's not the bank's money. That's your money. So the borrower, so you've got the depositor, he puts money in, right? Money goes in. You've got the borrower, he pulls money out of the bank and he pays interest, right? You've got the bank. The bank issues loans. He's the one that's taking deposits in and he's the one that's loaning these deposits back out. And then you have the shareholders of the bank. Okay, banks have shareholders. Most people don't know this. I didn't know this when I was a kid. I was like, I never thought that there was shareholders at the bank, right? What do the shareholders do? They get dividends. A dividend is a share in the profit of the bank, right? Most of us only will ever be number 1 and maybe number 2. That's the extent. We'll almost always only ever be number 1 and number 2. Some people will only be number 1. They're never going to get loans, right? But a lot of us, we're going to put money in a bank and we're going to take loans from a bank. And that's the only extent that we're ever going to see with this, right? Now, the bank is a deal maker, right? What is happening here? We have an opportunity. The bank has money coming in. It's a deposit, right? That's opportunity. I've got money. I could do something with it so long as these people don't withdraw it, right? Well, what's the opportunity? Well, I could loan it to that guy, right? This guy has money. He brings it to me. And then I loan it out to that guy. And then he pays me interest. I give this guy a piddly little amount of interest. Meanwhile, I'm charging whatever I'm charging here and I'm pocketing all the profits using none of my own money, right? So what do we have here? We have a deal maker and we have an opportunity, right? The depositor, he's not a deal maker. There's no opportunity there. He's loaning his money to the bank for 0.01% interest, right? The borrower, like he might be a deal maker. He might use that money he's borrowed and go put together a real estate deal or something of that sort. But guess what? Who gets paid first? The bank, right? So then you've got, okay, well, what if I could be both? Because I like this. I like being the borrower. I like being able to use money and make profit. But what if I could also be the bank? And that was the question that was posed to me. What if you could be the bank? And when I started thinking with this, I was like, okay, well, if I was the bank, that means that I would have deposits coming in, AKA my income. That's a deposit. When I save money, that is a deposit. I put it into my own bank. I would need to figure out what that is. And then I loan those funds out. I borrow against the deposits and I loan those funds out, right? And then on top of that, I would earn dividends on that system. So when I first learned this, I didn't know I could do this with life insurance. This is exactly how high early cash value dividend paying whole life insurance works to the T. I deposit my income into it, right? Once that goes on deposit, it's purchasing shares in the insurance company. I'm now an owner in the insurance company, right? I can borrow that deposit and I can lend it to myself, Why would I do that? Same reason Apple does it. Apple's headquarters is actually in Ireland. Do you guys know that? It's not in the United States, it's in Ireland. Why is it in Ireland? Ireland at the time was a tax haven. So if they put all their profits in Ireland, they didn't have to pay United States taxes. They have the system of franchises and LLCs. The profits flow through, go to Ireland. Now, when the US corporations for Apple need money, the Ireland company loans against its assets and lends them capital. Why? Because a loan isn't taxable. This is the other factor, right? So I put the deposit into my life insurance, right? And now I have the deposit. I'm now the banker, right? I have this money on deposit. It's growing. It gets dividends because I'm also a shareholder in the insurance company. I can borrow against those shares. I can borrow, it's called cash value. I can borrow against those shares, still get the dividends, and then loan it to myself and go make deals happen. I can do private lending. I can buy real estate. I can do whatever it is I want to do with it, right? But I'm allowed to now be the borrower. I can be the depositor, the banker, and also the shareholder. There's literally no other system that allows for this unless I literally go start up a bank, right? So this was my eye-opening experience where I went from, okay, well, you never buy whole life insurance because Dave Ramsey said, to, this is actually something I think I want to use, right? But I was a skeptic. For years of my life, I was like, you never buy whole life, you never buy whole life, you never buy whole life. So I had to overcome my own questions. I was the biggest skeptic I knew on this topic. I literally made a guy at New York Life Insurance who sells whole life insurance. I made him quit his job because I was so much more certain than he was on the fact that what he was selling was garbage because I didn't believe in whole life insurance. I was selling a term insurance and I was like, term is better. I literally was like, you're a criminal, all this stuff. And he quit his job the next day. He called me. He's like, hey, like what you said really hit home. I quit my job yesterday. So I wasn't just like certain. I was like freaking certain. Like quit your job, make you quit your job certain. And so when I started learning about this, I was like, okay, well, I was skeptical. I was like, what about this? What about this? What about this? So here's what I did. And here's what I would recommend you do. The first thing I got my hands on was an illustration. An illustration is a life insurance policy showing projections. If I put in this much cash, here's how much cash value I will have. Here's how much death benefit I will have year by year. Here's my contributions. Here's what I can borrow against. Here's the growth, right? Because until then, for me, it was a fairy tale. It was like, sure, cool concept, nice quadrant, right? But where are the numbers? And so when I started, looking at this from the standpoint, I might use it. That was the first thing I wanted. I was like, I need to get my hands on an illustration. I need to see the math. Okay. And I spent literally this was over Christmas weekend. This was years ago, 36 hours over the course of 3 days, only researching life insurance. That's the only thing I did for 36 hours over that weekend. And I was like in blogs, like in the depth. I didn't go on the dark web or anything, but I was like that close, right? I was like all these, strange backlinks. So I was trying to find PDF files. I was like, if I can find a PDF file of a real illustration and I could see this in real life, this would make me more comfortable with the concept. So that's the first thing you need. You need an illustration, right? Now, what do you want to see on the illustration? I'm going to actually pull up an example. Let's see here. So on the illustration, you are looking for a couple of things. Here's a good one. So this is just like a Excel comparison. It's a mock illustration that I'll show you guys as an example. So that as you're going through this process, you know what it is you should be looking for. Because this is like, it's like when you tell someone you want to lend money out, right? If you're like, hey, I've got money to loan, all of a sudden everyone needs a loan, right? Or if you tell someone you've got money to invest, all of a sudden everyone's got a deal, right? So you want to make sure as you're going through this, let me close a couple tabs so I don't have any lag on my computer. As you're going through this, you need to know what it is you're looking for and what it is you're not looking for so that you don't get taken advantage of. Because the last thing you want to do is go running down the street saying, hey, I want to buy life insurance, right? Everyone and their uncle is going to sell you life insurance, and it's not going to be the kind you think you want, okay? So let me share my screen. This is what an illustration should look like. This is what you should be looking for. Let me close these side tabs off. All right, so this is just the life insurance, right? So here you see sacred accounts. We're putting in $1,625 a month for 20 years, and you'll see a column for your annual contribution, right? So you're putting in $19,500 and it shows you the outlay. It goes all the way down. And this is what you would look for. You'd look for, okay, well, how long am I putting money in for? That's the first question I want to answer to, right? I want to know what's the funding period. Now, the next column you're going to see is the cash value. If I put in 19,500 in year one, I should be able to borrow about 15 grand. Okay. If we do the math on this, what is this? If we say 15,723 divided by 19,500, that's 80%, right? So I have about an 80% loan to value. I call this liquidity. If I put in 19 grand, I'm going to have about 80% liquidity on that money. I can take about 15,000 out immediately, right? So you should see 80%. We advertise 70 to 90. 80 is right, boom, smack dab in the middle. Okay. Now, here's the deal. There's a death benefit, right? So you have to understand, you are buying life insurance. There is a death benefit. The death benefit is completely arbitrary, right? Like we're building the death benefit based on giving you the best contribution. So I'm not looking so much at the death benefit. The number one thing I'm looking for is what am I putting in and what do I have available? And each year I should see that ratio improving, right? Now, the other thing I'm looking for is what is my break-even point, right? So if I'm putting in 19,500, usually we should see a break-even point around like year 7, maybe year 5, right? And what that means is my cash value is greater than what I put in. Okay. So let's say 19,500 times 1, 2, 3, 4, 5 years. What is this at the 5-year marker? Okay. So at the 5-year marker, I put in 97,500. I've got 95,188. So I'm not quite at a break even yet, right? Let's look at maybe 1 year after that. If we say over 6 years, right? So if I go times 6 years, that's 117,000 and I've got 117,643. So I broke even at year 6, right? So what does that mean? It means that the money that I have in my policy in cash value is more than I contributed. And so that means I can borrow more than I put in. Initially, it's like real estate. I can borrow, 70, 80, 90%. Year 6, it's better. I can borrow more than I put in, right? Like it's like if I had real estate and the property's been appreciating and I can borrow all of it, which you can't even do that in real estate. When a property appreciates, you still only can borrow, usually 70 to 90% of your loan to value, and you'd still have to refinance and do that whole shebang. With this, it's not that case. I don't have to refinance. The policy just grows. Okay. So these are the main things I'm looking for. This is the illustration. Now, here's what I was taught. I was taught when you buy any sort of cash value life insurance policy, years 0 through 3, your cash value is going to be 0. The reason why is because on a traditional cash value policy, the first 3 years, that's how they pay the commission to the agent. The cash comes from your policy. So the agent makes a ton of money, but you have no money. You've got no cash. You can't take a loan. It's 0. Right. And then year 4 or 5, you might have a couple $100 and then a couple thousand. And on a lot of these policies, it might take 15 or 20 years to break even. Okay. That's terrible. That's called time value of money. Why would I put money in something where it's going to take me 17 years to get my money back? Right. I actually had a policy that a client sent and he's like, hey, can you look at this for me? It was a universal life policy he bought. And so I looked at it and it was like a 17-year break-even period. And his internal rate of return was 2%. Okay. So that's the other thing I look at. So, right. The liquidity matters. What am I borrowing against? What's available? And then also, what is my break even? And the final thing, I said this to a client today, the main number I'm looking at is what did I put in and what did I get at the end? Right. And so when I look at this with a life insurance policy, if I'm borrowing against it, right, I'm borrowing against it, I'm investing, I'm looking at, okay, well, I put in $19,500 for 20 years. Okay. And so I've got a certain amount of cash value with that. I can calculate an internal rate of return on that. Usually that's going to be 3 to 5% compounding annual growth rate. That's also tax-free. In addition to that, I'm borrowing against the policy, right? I have to have about 50 grand to borrow. And when I borrow, I can do private lending deals. I can buy real estate and do seller financing, or I can loan money to an investment fund. I can also do self-financing where I buy a car or I buy a house and I make payments to myself. In this scenario, I'm going to take my loans every 50,000, right? So not only do I have my cash value growing, this is the part of, okay, I'm depositor, right? Here's my deposits. I'm putting in 19,500. That's step 1 of the bank. Okay. The step 2 is the loans. Okay, so over here, I'm going to borrow $57,000 against my life insurance. Why? Because that's the point where I'm going to do a real estate deal where I earn 12% on a private lending deal. What did I just do? I'm the banker issuing myself a loan and then taking that loan now as the borrower and then loaning that out now to somebody else to get income from it. I could also buy a rental property if you want to do it that way too. I think there's more time involved with doing the rental property. I like doing loans. So I've now got the first three quadrants. I've got deposits, I've got loans, and I'm the banker. Okay. Well, why is my cash value growing? Because I'm getting dividends. The insurance company shares their profit with me every year. I'm a shareholder. Right. So now I'm also earning dividends. That's the fourth quadrant of the shareholder that I was telling you about. Right. So when I take all of this, my contributions, my cash value, and I keep doing these deals every 50,000 or so, I'm doing a new investment. Right. And so I'm going to continue borrowing and then repaying and borrowing and repaying. When I go all the way down, I've done $6 million. This is in 33 years time. I've done $6 million in arbitrage investments. Okay. I still have $2.1 million in death benefit. I've got $940,000 in cash value. My annual growth rate is 9.16%. Right. If I were to try and get this with like real estate or stocks, I would only get 8.16 because I've got to pay taxes. Right. I've only got about $2,900 in fees. And on my real estate, I'm paying about 1.8 million on those loans. I can mitigate those through tax planning. So we could almost get rid of this number if we wanted to. Right. And so that's something where I can look at this and say, okay, well, I'm doing all of these things now. Right. I'm doing the depositor saving. Right. And that's the great thing with this, guys. As I'm saving, my net worth goes up. All of these things grow my net worth. My net worth goes up because I saved more. Right. Well, when I saved more, I put it in a life insurance policy. It grew. My net worth went up because the cash value increased. Right. It didn't just stay there. I borrowed against it and did private lending deals. When I do private lending deals, my net worth goes up again because now I've got principal outstanding on a loan plus interest earned. Okay. And then I'm also earning dividends. Look at all of the ways I'm increasing my net worth with that. Right. So I have to be able to think with this. And a lot of people don't cover this because they either gloss over it and they're trying to tell you about the life insurance and they don't give you all of the facts. Right. And so they tell you the marketing pitch, like, oh yeah, you can become your own bank. And it sounds awesome, but they don't know how to actually implement it. And they don't know how to answer the nitty-gritty questions. Okay. Or they get way too granular. They get way too into the nitty gritty. And it's like, well, this is cool. I know what the internal expense ratios on a policy are, but how the hell do I use it as a bank? Right. And so we want to bridge the gap. We want to know the concept, the banking quadrant. We want to know how to look at an illustration and make sure we're getting the right thing. Okay. So what I want to do, I want to open this up for some questions. Next phase of this conversation tonight is going to be specifics on policy design. Okay. So I want to answer any questions you have really quick. I'm going to take a look and see if we have any in the comments. If you're on Zoom right now, drop your questions in the chat. Again, if Nano sent you a DM, check your messages. If you want to grab a copy of my book, Blueprint to Financial Freedom, you can do that as well. Reach out to Nano or go to jerryfetta.com/B2F. This does come with a free consultation. So if you are not a client yet, that's a way you can become one. Get the book, get a free consultation. So let me answer questions on Facebook here first. Let me see if we have any questions. And again, if you're on Zoom, drop them in the chat and I will go live with you and answer your questions. All right. Good to see everyone on Facebook. Andrew, what's going on? Good to see you. Sean, good to see you. Okay, I don't see any questions on Facebook. Let me check on Zoom here. Let's see. Nano says he didn't know the Gato Grande, the sexual innuendo meaning of that. Now you know, Nano. Don't. It's a slippery slope. Don't say it on accident. All right. I do not see any questions yet. Okay, we have a question from Mark. Let me bring Mark Perry on. All right, we're live with Mark. How are you tonight, Mark?
Hey Jerry, nice to see you again. I got a bit of a cold, so excuse my voice.
Oh, that's okay. So your question was on the loan interest, right?
Yeah, in that scenario that you ran with the illustration, I may have missed it. If I did, I apologize. But you didn't mention the cost of the loan from the insurance company as you went forward.
Yeah. So I believe this is a illustration from Guardian. So their gross loan rate is, I believe, 5.65. They match it with their dividend. It's either 5.65 or a flat six. I need to check what it is right now. This is a net effective cost. So this is it's gonna fall somewhere around like 3 or 4. Nano says 5.65. And the reason being is the cash flow from these investments is paying the loan principal down. And so that's going to reduce the net effective. And then we're also going to take that actual cost and we're going to write that off as investment expense on our taxes as well. So I don't have the exact number here, Mark, but it's going to be usually like 3 or 4%. And that's direct with carrier. You could also do a cash value line of credit with a bank, and that can get you down even lower. But we didn't illustrate that on this one.
Yeah, that was my next question. The cash value line of credit, which seems to always have a little bit better cost as far as the loan is concerned. Do you have any recommended companies that you deal with cash value line of credit?
Yeah, we do have a couple. Send me an email, Mark, and I'll get you connected up with them. And that's something that we usually will do with more experienced clients. So we want someone to take a loan a couple times with the carrier. Mark probably has, but with a carrier loan, the interest is either withheld off the top and then it's reimbursed as you pay the loan back, or it's due at the end of the year. And that's different than if you go to a bank and you get a cash value line of credit. That's going to be a variable rate and it's due monthly, right? And so it's kind of one of those things of let's walk before we run. So it's actually safer, even though it's a little more expensive, it's safer to start with a carrier loan, to do it direct with the insurance company, because nothing bad can happen, right? I'm not going to miss a payment. Like, it's very insulated and protected. Once I've done several of those, then I can say, okay, let's do the cash value line of credit. There is more risk. It is with a bank. And so that's, something that we do. It's kind of like bowling with bumpers on and then taking the bumpers off. So good question there from Mark. So yeah, Mark, send me an email on that. Let's see here. We have a couple more questions. Jessica has a question. So let me bring Jessica on. She has a question on the Sacred Account Lite versus the Premium. Let me bring her on here.
Hey, Jerry.
Jess, how are you tonight?
Good. How are you?
I'm good. Long time no talk.
Yeah. Yeah. So I was just curious. I mean, I'm going to be transitioning into Sacred Account Premium, and I was just curious if you might be going over any additional details about that I might have missed. Feel like I have a good basic understanding, but was just curious if you might be covering some of those things tonight as well regarding premium.
Yeah, totally. I can do that. Yeah. So the Sacred Account, and I'll share my screen and draw this on the whiteboard. So with the Sacred Account, basically we have what we call a Lite account, and we have what's called a Premium account. Right. So the Lite account, these are two different purposes, right? So the Lite account is going to be typically for paying off debt or building up cash reserves. So the main focus here is ultra high liquidity. We want as much money as we can get in year 1 and 2 and 3, even if that means it's not quite as much growth down the road. And the reason why is if we're paying off debt, more money now is better. If we're building solvency, more money is now is better. So this is typically going to be a 7 to 10 pay. And what that does is it shortens the contribution period and it chops it off, meaning, somewhere between 7 to 10 years, that's basically the cutoff point. After that, we can't put more money into that policy. What that does is it forces more of that liquidity into the front end of the policy by creating that stop there. And it basically gives us a higher cash value. So we've got more money to do things like pay off debt, build up reserves. Now, the other thing here is this one is a lower ongoing premium requirement. So this is a lower premium. And that's, again, it kind of plays off of the 7 to 10 pay. on a premium account over here, and there are two different words premium being used here. There's premium, like the money I'm paying into a policy, like an insurance premium. And then there's premium, like a upgraded model of something. So I want to make sure that that's clear. So over here, the premium is lower. And because we've got that 7 to 10 pay period, that shortens payment period, we still see good liquidity and good growth. On the sacred account premium, we're going for, like maximized growth over the long haul. We want to see the highest internal rates of return. That requires us to put more minimum money into it, right? So this is going to be a higher required minimum. So that's going to be two of the main differences. On this one, it grows with the company dividend. And that keeps us steady. There are options on policies. We'll talk about this in the premium where we have different options for growth. And so with those being, put on, those are technically riders. They've got internal fees. And so there can be a drag on policy performance on those other options if they don't perform as well as we project. With the dividend, there's none of that. We already know what's going to happen. There's no other costs involved. This one also has no riders. Okay, a rider is like an additional bell or whistle that we would put onto an insurance policy. Those are cool. They've got benefits, but they also have costs. And so once again, if we're paying off debt, if we're building reserves, we want the most streamlined, high cash value we can possibly get. And so that's what the light does. Now with the premium, this is going to be the difference. This is going to be either a 20-year or age 65. One of the two, whichever is more. So if I'm 50, right, it's going to be a 20-year. I'm going to pay in for 20 years. If I'm 30, I'm just going to do the age 65, right? So that's a longer premium pay-in period. That also gives me more growth. Every time I buy death benefit in an insurance policy, I'm getting equity shares in the insurance company, and that's producing a dividend off of each of those units or each of those shares. So by giving a longer payment period, I'm buying more shares over a longer period of time and getting a higher dividend because of that. This does have a higher premium requirements. So the contribution, let's go ahead and just use the word contribution to avoid confusion. Higher contribution requirement. I've got the dividend option, but I also have the index option. The index option says that I can opt for the company dividend, or on an annual basis, I can take a portion or all of my growth and allocate that into an S&P 500 index, which means I can get a percentage of what the stock market does without actually ever being in the stock market. I can't lose money in the market, but if it comes up, maybe that outperforms the dividend. And this is something that when you look at the dividend, they're heavily based on interest rates. When we're in a high interest rate environment, the insurance company dividends typically go up because they have a lot of loans. They get commercial loans. They lend money to people like Grant Cardone and all of these funds, right? So when rates come up, they get more interest on these loans. When rates come down, dividends go down typically as well. Now, the thing that happens is when rates go down, typically stocks go up, right? When money is cheaper, there's more money that can be borrowed, spent, and invested, stocks come up. So if I'm looking at this each year, I can play off of, okay, well, and this is a little bit of predict. I predict rates are going to go up. I want to be more in the dividend. Okay. Or I predict rates are going to come down because of the economy being maybe in a bad position. They're going to have to bring the rates down. I think that's going to send the stock market up. And then I'm going to be over in that bucket. I want to catch that side. Or I could just do 50-50 or 75-25, but I can actually pick and choose with my growth there. And then this one does have riders. Right. So a couple riders, the index rider is one of them. There's another one that is a advancement on your death benefit for critical illness, chronic illness, or terminal illness. You can also add disability riders, long-term care riders. So there's a lot more we can put into it. And the reason being is we're putting in more money, we're earning a bigger dividend. So we can afford to have extra costs in the policy if we need to. So those are the main differences. The purpose here on the premium account is wealth building. Right. I've already paid off all my debt. I already have my reserves. At this point in time, it's how much cash value can I accumulate, because I want to be taking loans and doing deals with, private lending and real estate. I want to have a maximum internal rate of return and all of these things. And then the final thing here is typically with a light account, we are going to do insurance company loans. And the reason why is the insurance company is your bank, you're a shareholder, right? And so when you have debt, for example, you want to protect yourself from being further in debt. That's the wrong way to have happen is I'm in debt. Now I have more. One of the ways to do that with financial institutions is to align yourself so that whatever they do to you, they do to themselves. So I'm going to repeat that. You align yourself so that whatever they do to you, they do to themselves. If I am a shareholder in the insurance company and I'm taking loans from the company that I own, if they do something to me, they're also going to be doing it to themselves. They're not going to do anything to me that they're not going to do to themselves, right? On the premium account, this is what Mark mentioned. I can do a cash value line of credit, but this is a bank. They literally don't give a crap. They're just in it for interest. I'm not an owner. I'm not a partner. And so there's a lack of alignment there on they want to take as much of my money as possible for the longest period of time, regardless of whether or not it helps me, versus with the insurance company, they want to make sure that my policy stays on the books. They want to make sure I'm a client of theirs and a shareholder of theirs for a very long time. So on this one, I'm going to, on the light account, take insurance company loans. On the premium account, I'm going to be taking cash value loans. And that's going to give me a little bit more arbitrage spread as I'm doing these investment deals, because that really, really matters the most at that point. So those are some of the main differences. And I want to state, most companies don't do this. Most companies, they just say, how much money do you have? Let's put as much in as we can. And they don't they don't think about, okay, well, are you trying to pay off debt? Are you trying to build reserves? Are you self-financing vehicles? Are you the investing stage? It's just vanilla. Like, how much do you have? How long do you want to put it in for? And that's it. So this is a unique thing to Wealth Dynamics. Good question there from Jessica. And I think that that's something that probably gives a lot of context to a lot of people. Okay, good. We've got a couple more questions. Let me answer some of these. All right, we have a question from Andre. Let me bring Andre on. All right,
Hey,
we're
Jerry.
live with Andre. How are you tonight, Andre?
Hey, good, pretty good.
Awesome,
Hey,
awesome. What is your question?
yeah, I was looking at the illustration and that arbitrage column you had. I wanted to
Yeah.
see how you got the reoccurring $50,000 investment and at what point it hit 6 million. See how you got those numbers.
Yeah, I can send you the spreadsheet to take a look at.
Okay, cool.
The long story short on it is, obviously you have your deposits, right? And then you have your cash value growth. So that's building your cash value up. As soon as it hits 50, you're taking that loan and then you're getting the passive income from that loan because you're investing it, right? Now you have two things happening. You're still making the deposit, and now you're also taking the passive income from the loan you just did on that investment deal, and you're repaying your cash value. So it's going to accumulate faster. Plus also it's still growing. So you're going to get to the next 50 a little bit quicker. And then you're going to do the same thing. You're going to borrow that one out, do another loan. You're going to get another $500, $600 in addition to the one you're already getting. Plus you're still putting in the 19.5 each year. That's going to snowball. And it gets to the point, and I can actually share my screen really quick. I don't want to get too into the spreadsheets because not everyone is a spreadsheet person. It gets to the point where the compounding on this, Andre, you can see it compounds much more rapidly, right? So it goes from, I need, 2 years to get to my first loan. And then on this one, I need about 1.5 to 2 years. Well, now I'm doing one every year, right? So I've got 128 to 169. That's another 50 already. I've got 169 to 214. And I continue doing that. My cash value is growing along with me. And so I'm continuing to borrow every time that happens. And these increments get much and much shorter, right? So as we continue going down, this is going to be the cash value. And then this is going to be the principal on the loans, because each of these loans has a principal amount that's extended plus the interest income coming in. So it just starts to snowball and compound. And as it builds and builds and builds, it gets that exponential effect. So Andre is a spreadsheet guy, so I'll send him the spreadsheet here. And that's one thing I want to point out that Andre's question brings up a good point. That's the difference, what I just showed you, between retirement, the nest egg concept. I'm going to build up a giant pool of money and try and live off of it when I'm 60, and hopefully I die before it runs out. The difference between that and what I just showed you, which is financial freedom, right? Like if I've got, just to give you like some reality on this, if I've got $6 million in private lending deals from life insurance loans I've taken, if I'm earning 12% interest on that, guys, that's $60,000 a month. Okay. And I've only put in $19,500 a year for 20 years, right? Not any different than, why did I use $19,500? Because the time I did this illustration, that was the maximum you could put into a 401k. And so I was trying to illustrate the point. You're already doing this. You're already putting, if you're maxing out your 401k, you're already doing it. You're already putting aside the money. It's just going to the wrong people. It's going to Wall Street. The thing I talked about at the beginning, it's buying retail financial products. It's going, you're funding the deal makers. You're giving them your money so that they can make the deals instead of you making the deals. So that's the key thing. Like Nano says, giving up control of your money. Okay, let me see what other questions we have. Let's see. We have a question from Jorge. Let me bring Jorge on. Awesome questions tonight. All right, we're live with Jorge. How are you tonight, Jorge?
Good, Jerry. How about yourself?
Hey, I'm good. Thanks for asking. So what is your question?
Yeah, I was going to ask you if you have a preference in policy design, for instance, a 1090, 4060, because there's a lot of people that prefer one over the other. And I just wanted to hear your thoughts about that.
Yeah, that's a good question. So that'll kind of be covered on. So if you remember the light account versus the premium account, I'm always going to pick one of those two. And it's based on where the person is at, where the individual is at. There's a book that I read a number of years ago. I asked one of my mentors, I was like, what's the best financial book you could read? And he gave me a book called Calculator Power. Right. And it is, the dorkiest, nerdiest book in the world, but it's all about financial calculators. Right. And so one of the key datums, like when you're looking at, the investment of money and the time value of money, one of the key axioms there is that more money now is always better than more money later. Right. So when I'm looking at life insurance, okay, well, if I do 40/60, I've got less money today with the potential for more money later, because I could have higher dividends. Right. But if I have 90% of my cash value, I can be doing more private lending deals today or paying off my debt today. And that's going to give me more profitability than the dividends will. Right. So that's where on that light account, I want to jack the liquidity up as high as it can possibly go. Right now on the premium account, I'm still going to jack the liquidity up as high as I can possibly go, but I'm extending it out for the long haul. Right. So I would never do a 60/40. I would, 70/30 is probably the worst I would accept. Right. Which means that 70% of my deposit went into cash, 30% of it went into, death benefit and it's buying shares. That's the least I would do, right? Maybe 65/55 if I've got bad medical ratings and I can't get a better deal, right? But that 70/30, that's like for me, the bottom cusp. At that point, it's like, okay, well, I'm losing out on too much money and I could be using that money instead today to be doing smart things with it. Very good questions. We've got a question from Lorraine. Let me bring Lorraine on. Oh, but it doesn't look like I can bring Lorraine on. Lorraine, it says your Zoom, update your Zoom at some point, and then I can unmute you. But Lorraine asks, can you confirm that you can only take a loan at 50K? So no. So you can take a loan anytime, right? So if you have $1 in there, you can borrow against it. If you've got 10, 100, doesn't matter. 50K is when you're doing a private lending deal. That's about the minimum you need to do a private lending deal. So like for a lot of our clients, they might have like 10,000 on a car debt, and they're going to borrow that 10,000 out from their cash value and pay off the car loan. And there's no minimum loan requirement. But this is just, if I'm going to do a private lending deal, the deal is going to require at least 50K. So I want to make sure I've got that in my cash value. Holy cow, we've got a great success story. Let me bring Brian on. All right, Brian, I think I've got you off mute. Let me know if you're able to mic up. All right, we're live with Brian. Brian, do you want to share the news?
Yeah, I used my sacred account today to pay off all of my debt. I have 2 mortgages, but other than that, I paid off my Jeep today, so I'm ready to go to the next step. Excited.
That's phenomenal, man. Congratulations.
Thank you.
Feels good, right?
Oh man, it feels amazing. Yes, I was telling my girlfriend, I'm like, I'm so excited. I'm 42, and this is the first time I think I've ever been completely out of debt other than a mortgage.
Yeah, that's incredible. Yeah, so we'll get you moving on your next phases now.
Awesome. Thanks.
Keep up the good work. Awesome. Yeah, that was a client. So he paid off all of his debt with his sacred account. That's phenomenal. Let's see here. We've got a question from Frank. Let me bring Frank on. Very good
Hello.
questions today. We're live with Frank. How are you tonight, Frank?
I'm great. How you doing, Jerry?
Hey, I'm good. Thanks for asking. What is your question?
Yeah, so I'm just thinking about, let's say you got your debts paid off, you got your reserves, and you want to focus on using the sacred account for retirement. Is your focus to put as much money into your sacred account as you can? And then the income that you're going to get when you retire, that comes primarily from the deals that you make, like for passive income?
Yeah, that's correct. Yeah. So that would be the way I would do it, is I would put in as much as I can and build the policy up and be borrowing against it. And every time I'm borrowing, the purpose of that loan is to do an investment where I'm producing passive income. And then when I'm ready to like retire, and I don't like that word necessarily, but when I'm ready to live off the passive income, because I believe everyone should still be active in life and have a purpose instead of retire. But when I'm ready to live off that income, I basically just direct the income to myself instead of paying back my policy loans, as opposed to building up a nest egg and trying to live off of the growth of the dividends or the stock or whatever it would be. You can do that model with whole life. I don't love that because it really limits you, right? But if you want to just live off dividend income, you certainly could. But doing the lending and doing deals with that and then producing that passive income is the route that we would go. Lorraine asks, how do I determine how much money to put in? Very good question. So there's a couple things that's going to depend on, Lorraine. So the first one is going to be, where are you at with your finances? Do you have debt? Do you have your 6 months of reserves? If I'm someone, let's say I have consumer debt, I want to be able to fund it with enough money that I know I'm putting in enough to pay off my debt. And that's going to be subjective. That's going to be based on my situation and my numbers. Our team will help you figure that out. Same thing with if I have no debt and I'm like, hey, I want to do my 6 month reserve and I want to put that there for my reserve fund. What is that 6 month number? And, either on a lump sum or an ongoing basis, am I actually putting in enough money where I'm going to get there? If I'm beyond that, then it's strictly, okay, well, I want to do deals. I want to do investing. I want to put in as much as I possibly can. Right. So a lot of times our clients might start where they've got debt. They don't have their 6 months yet. And so we help them set up a light account. Minimum there is $250 a month. You can do usually up to about 15% of your income. And we're going to help them free up cash flow. We're going to get rid of their debt. We're going to reduce their insurance costs. We're going to help them reduce their taxes. And so by the time they get through all of this, they're saving more money than they ever had, so that when they upgrade to their premium account, they can put in a ton. Like, it's way more than they could have before. Right. And so that's the purpose of that. Very good question there. All right, Nano has a question. Nano, do you want to go ahead and unmute and ask your question?
Hey, Jerry.
Hey, Nano, how are you?
Doing great, man. You?
Good, good. What is your question?
Yeah, very good. So you mentioned that the two options for funding sacred account premium would be up to 65 or up to 20 years, whichever one would be greater, correct?
Yeah, that's correct.
Good. So is that an option that if I want to be funding up to, a longer period, for example, and then at some point, let's say that I want to work until like I'm 70 or 80, right? And then I'm 30 years old and I want to fund this policy for the next 40 years. Is that such an option or a possibility?
That is, you could go longer. Yeah.
Okay, very good. Thank you.
Yeah, no problem. I like the way Nano is thinking. Mark says, I like to use the word deposit instead of premium because of my personal reference to the personal bank. I like that. I think a deposit or a contribution is better, but I think deposit matches the banking lingo much better. Awesome, Jessica. I'm glad that answered that question for you. All right, let's see if we have any other questions. Jeff says, not a question, but I'm fairly certain I have the same world map decoration that you have in the back. Awesome. Great minds think alike. Let's see here. Brian, a bunch of people said, good job. Congratulations. Okay, cool. That's all of our questions there. Let me see if we have any on Facebook. Okay, so we have a question from Rebecca. How do you increase the contribution on your account aside from the monthly paid up addition? So that's a good question. So basically, when you do a sacred account, you have your base like your monthly or annual scheduled contribution. Then there's going to be a MEC limit, like how much more could I put in up to the annual limit without creating a taxable event. If I want to raise either of those two numbers beyond what they are, I either need to do a policy modification, which means on the back end, I'm going to go to the insurance company and say, hey, my income went up. I have to prove that my income went up. Why? Because they're not going to give me more life insurance if I don't have a financial reason for them to insure me. So I have to prove my income went up. If my income went up, then I can have them redo underwriting based on my new income, increase my death benefit, which increases my MEC line and my contributions. So that's the first way. The second way is doing an upgrade to the sacred account premium, which we do on phase 1. And at that point in time, you know, the income went up, but also, like I mentioned, we got rid of debt and we reduced taxes and insurance and all sorts of things. So not only is my income higher, but my savings rate is higher too, because I've got less outflow to other things. So that's a good question. Rebecca, if you reach out to me, send me an email and I can get Rodrigo and my team connected to help you with that question and see what we can do to help you increase that. Okay, Andrew says, does the index rider have to be added to the policy when it's being created, or can a client add that rider at any time? So Andrew, that's something that on the sacred account premium, we would do that during the design. And then if you've already done one where it's like I did a premium or I didn't add the rider, on the policy anniversary day, we can submit a change request and say, hey, you know, on the anniversary date, we want the index rider added in. And then at that point, you'd also determine what percentage you'd like to go to where, right? So that's something that I think we are either currently working with you on, or we are just finished, right? And so that's something that we can help you with as well. Let's see here. Question from Vincent. So no rider means I can't add money to the cash value outside of the monthly payment. Not quite, Vincent. So no rider, it does not include the paid up additions rider. So the paid up additions rider is on both the light account and the premium account. That's not a rider that has an associated ongoing fee with it, like for performance. So that's there. So you've got your base contribution and then you've got your unscheduled contribution. And then you can dump money in. Keith asks, so you would have minimal money in a bank and in your life insurance. So Keith, I only keep a month of cash in the bank. That's it. So I don't keep more than 1 month of dollar bills in the bank. That's literally the only cash that I have on hand, enough to run my company for a month and enough to pay my household expenses for a month. Everything else is in life insurance or gold and silver or real estate or private lending. And so that's something that I do. Lorraine asks, how do you get a policy with pre-existing conditions? Good question. So pre-existing conditions would mean if you have like a medical history, like you know, diabetes or cancer or heart disease, whatever it would be, high cholesterol, right? So sometimes if it's been long enough, you can get a policy and it's going to be totally fine and there will be not much of a difference. Other times you'll get what's called rated. So if you get rated, the insurance company is saying, hey, we're going to charge you extra for your death benefit because you're a higher risk. Sometimes that is okay and we're able to make it work. Other times that's going to make the internal cost of the policy too expensive and the rate of return is going to drop significantly, right? So if you get rated or declined, that's the other option. They just say, hey, we won't cover you, right? Now, if you get rated where it's not financially a good idea or you get declined, what I would do is you're allowed to own a policy while you insure someone else. So if you have a spouse or a business partner or a relative or a child or a grandchild, you can put coverage on them. You're the owner. You're the one that's going to fund it with deposits, right? But they're the insured. They're healthy. They're maybe, you know, young or whatever it would be. And so you can use the banking process with them as the insured. And that way you kind of avoid the rating, you know, whether that's a decline or a rating. And that's all something, Lorraine, that's all something we do in underwriting. The first thing we do is we would just apply. Like we would just apply and see what we can get. If they give us a good offer, great, we can negotiate. If not, and if it's a bad offer, then we would look at, okay, well, who else could we insure instead? Really good questions tonight. Good. Let me see if we have anything else on questions. Nope, I didn't even get into the rest of what I was going to talk about. So really quickly, I'm going to hit you guys with a blitz. What is the other thing you need to look for? So you want to find the right company, okay? So when I'm doing a sacred account, I'm literally mimicking the banks. You guys might not know this. The largest banks in the United States keep 20% of their tier 1 capital in life insurance, in dividend paying whole life insurance, literally the same kind we're talking about today. So we're talking Wells Fargo, PIMCO, JP Morgan. This is what they use. Okay. Now, when they set these up, if you talk to them, and you probably won't, but the guys we work with do, the banks will usually work with one of four carriers. Okay. Guardian Life Insurance, Mass Mutual, New York Life Insurance, and Northwestern Mutual. Those are the four they're typically going to work with. Okay. So when I'm looking for carriers, I'm going to look at the same ones. I'm not going to look at the tiny little carrier that's, and here's the thing is these guys like New York Life, Northwestern Mutual, Guard, these guys are all, 150 something years old, 170 something years old. They've paid dividends for more than a century and a half in a row, right? Like you can look at the track record and that they're going to pay, that they've been around for a long time. Okay. They disclose all of their financial numbers. With insurance companies, there's something called a Comdex score. A Comdex score is a financial rating. Some of the insurance companies don't disclose them. They don't want you to know their Comdex score. Some of them don't tell you their dividend rate, right? They just tell you it went up or it went down. They won't tell you what it is because they don't want you to know what the internal costs are, right? So you can't just go to any company. I'm going to go with one of the big four, right? So in an insurance policy, usually you're going to see vocabulary that states that they have the right to wait 6 months before they issue a loan. Not that they're going to do that, but they have the right to. Okay. So there's a contract. They want to have as much freedom as they can. Some insurance companies don't want to issue loans. They're against the banking concept. So sure, you can set up a high early cash value policy, but when it comes time to take a loan, they're either going to say, nope, they're going to tell the agent, hey, don't be telling your clients to take loans anymore, or they're just going to drag their feet and make it a very difficult process, right? Guardian isn't that way. Okay. Mass Mutual isn't that way. Okay. New York Life can be. Northwestern Mutual is definitely that way. Okay. So those are all factors. And then I also want to look at what's the dividend performance, right? I look at what's the highest dividend rate. Usually Mass Mutual is the highest. Okay. Guardian is usually right up there with them. New York Life is usually up there with them as well. Northwestern Mutual has a horrendous dividend. It's like only less than 5%, might be 5% flat. Right? Guardian, I can get 5.85, 5.65. New York Life, Mass, they're usually about 6. Okay. So those are all factors as well. Thank you everyone for tuning in. I appreciate you all. Have a great weekend. If you're watching this and you want to learn more, there is an entire chapter on this in my book, Blueprint to Financial Freedom. So if you go to jerryfetta.com/B2F, you can get a copy of this. You can also set up a call with Nano. And guys, again, this is all about taking over, getting control of your finances, becoming your own bank. That's all I've got for this weekend. Thank you all. Have a great weekend. I'll talk to you next time.